Friday, and then the world's a different place today on Monday. Jake, hi, good afternoon. Surabhi here. So, before we start talking about the Indian market, just on the US, what do you think can stop the panic? The US government has come out saying we're standing behind all depositors. Then there is this new term funding facility that's been opened. Some new fancy name has been coined. It's basically a one-year loan arrangement that the Fed is providing. This other bank, here they have a credit line, I think, even from JP Morgan. Markets are still roiled. They're doing what they are. So what can stop this, and what can start that equity rally that we've seen in the previous instances? Every time once the Fed comes in and starts cutting, that's when equity markets take off. Will it be somewhat similar this time?
Well, I don't think we can talk about cutting just as yet. I think we need to have a couple of meetings where they actively sort of talk about the fact that they are worried that this relentless increase in and the pace of increase of these of interest rates has ripple effects which they are not bargained for, based on which they'd rather err on the side of caution and not increase rates. That has to be the first step before they move to the next step of saying, go through maybe 2-3 meetings of no interest rate hikes. And that's probably what the market is almost forcing the Fed hand as we speak. The Fed hand today is driven by not just the cost of bailout. Please understand, the US government has $21 trillion in debt. Compared to a year and a half ago where they were servicing this at 1% effectively, today you're servicing it at close to 4.5-5%. That's an increase of $600 to $800 billion a year. Or put it differently, it's a $1 trillion of it's $1 trillion of interest liability per year that they have to service. So is it that cost that they bear, or do they bear the cost of bailouts? That's the big question. And my own feeling is the markets will force their hand to keeping and the markets are presaging that interest rates will not rise any further at the same pace at any rate, and probably peak out maximum one rate hike of 25 basis points and then a peaking out is probably the way I see this. And I wouldn't rule out the possibility of even no hike a few days from today.
The debate about what's happening in the US is it throws up opportunities for a very rich debate, right? There's so many angles to it. So, but for a viewer here, Jakes, what does all of this now mean? We're at what 17,150. Is there significant downside from here? When I say significant, I mean another 400-500 points, or you think this is it? These are good levels. What's your sense?
Even the last time I was on your channel maybe a month and a half ago, I did talk about a 17,000 to 17,300 as being the sort of base for the moment. I mean, one way or the other, excuse me, it seems to be there. I would think it's a good level to be picking up, specific stocks in specific sectors. We, for instance, like integrated the metal sector, the integrated players. We like PSU banks at these levels. We think that capex and industrial private capex-led industrials, maybe defense, this is the way going forward. And you have to stay away from the overall, consumption themes, FMCG, technology. So at one level, the unloved, underowned, but possibly rich in value stocks will be the ones sought after. And you need to be a contrarian, because if technical levels can, make people sell, then you could have fair amount of chaos in the market without any fundamental reason. But markets don't bottom out with logic always. But I do believe that index-wise, these are good levels to enter, especially in the spaces that I talked about.
Do you see any reasons for the markets to move decisively lower, well below 17,000, perhaps head to levels of 16,000? Are there any triggers in the near to medium term which could take us down?
If triggers were there, it would have already happened by now. So I think I wouldn't say that there are triggers that we are aware of. But right now the banking sector issues seem to be concentrated amongst a few smaller names, and that may well be the silver lining. But sometimes that is, as they say, that akalmand ko ek ishara kafi hota hai. So in a sense, if the Fed, which is a smart bunch of people, can take this as a sort of early warning that further rate hikes could pressurize other sectors. My own sense is that that may be the route they take. So I think we've got to, but never mind what social media talks about people in the US, and this jingoistic talk of saying, look in your backyard before you advise us what to do, kind of nonsense. The reality is some smart people are there, and they realize that, in my opinion, that's why the speed of action of keeping depositors protected, literally in 24 to 48 hours. So from that perspective, I think there are a good bunch of smart people there managing affairs. And my personal feeling is they will opt for a more cautious orientation towards interest rates. And that could well mean, as I said, a max of one interest rate hike of 25 basis points and no more beyond that.
Got that, Jakes. By the way, the bank Nifty is looking at this crunching 900-point fall. Banks started to sell off on Friday as well. Not that there is any connection between what's happening in the US and here in India. But anyway, Bank Nifty and big banks leading the fall. So, Jakes, before we let you go, what is the advice? At some point, if that scenario plays out that we've been discussing, that the Fed gets into a pause and gets a little more benign in its outlook, then how does one prepare for that? And in terms of portfolio shifts, what do you do? Do you buy down some of these beaten banks? What else? Earlier, the market had a very clear disposition towards government capex. So I'm just asking, what's the portfolio shift to make over the next couple of weeks as we perhaps get into that scenario?
As I mentioned, public sector capex is visible in defense companies. It's also visible in some industrials in that sense. Private sector capex is visible in steel. It's visible in cement to an extent. And I think if you go by history, the 1 year in the run-up to general elections and the couple of years thereafter is usually the best period to invest in capex and capex-oriented and industrial stocks, because that's where the maximum offtake, maximum number of projects, etc., are awarded. So from that perspective, that's the space to be in. It's a space which currently is under-owned. Perhaps defense has seen some ownership shift, but that's also not institutional as much as it is HNI and trader-driven. But all the other spaces have seen only tactical action, nothing strategic. There's been no big shift of money into the spaces that I talked about. And from that point of view, the under-owned spaces offer some degree of respite. I'm not one who's necessarily worried about FIs selling, because the same FIs who take tactical positions against also come back to cover. So that's neither here nor there. I think fundamentally, retail individuals, if they continue with their SIPs, I think are probably better suited to and better advised at this point in time. Because if you've been putting SIPs in over at higher levels, there's a time you should not. Usually the SIPs stop at times like this, which indicates that people buy into frenzy but don't buy into despair. And that's exactly the wrong thing. So from that point of view, I think I would say from an individual point of view, SIPs should continue. And from an institutional point of view, some of the beaten down sectors will offer solace. But beyond all of this, I think the reality is that the dollar index is on a decline, and activity in China has taken off in a big way. The Chinese premier has reinforced that time and again in the last few weeks. And from that perspective, between China and India, I think the world will start looking here. This, ladies and gentlemen, may well be the place to focus on. And emerging markets could actually be the place to derive some solace for global equity-oriented funds.
Okay. All right, Jakes, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. As Jakes is saying, as has happened so often,